Hello, welcome in. Hello, welcome in. Welcome, welcome. Hello, welcome in. Hello, hello. We'll get started in 1 second. Hello. Hello. Okay. I want to make sure y'all can hear me. Sorry about the echo. And I want to make sure y'all can see this the book. Okay, today is July the 5th. It's 2:28 p.m. Hey Simba, I'm good. How are you? Thank you for letting me know you can hear me. Hey New Start. All right, guys. So we are on the last chapter of the Candlestick Trading Bible. When we finish this today, I'm gonna go over to YouTube and then I'm gonna summarize entries for all of these candlesticks and also outline all of these candlesticks, okay? Or maybe we'll just do it here. I don't know. We'll see how I'm feeling when we finish this. We have about 20 something more pages, okay? Quick recap if you haven't been here. All right, all of these, the past couple of videos that we've done, they are on YouTube, okay, explaining all of these candlestick patterns. So we talked about the bearish engulfing bar. We talked about the bullish engulfing bar. We talked about the doji candlesticks, the dragonfly doji, the gravestone doji, the morning star pattern, the evening star pattern, the hammer, which is also known as the pin bar. It's the bullish pin bar. The shooting star, which is the bearish pin bar. The harami pattern. The bearish harami. The tweezer bottom. And tweezer tops. Okay. So these are all of the candlestick patterns that we went over that they're talking about in this book. Okay, and the last chapter that we are going over back. Sorry about that. The wind just closed my back door and I heard the alarm say door. Okay, so what was I saying? I'm trying to figure out where we were. So I know we talked about the inside bar last week on Thursday. Oh, you know what? I came on Thursday and we talked about the inside bar, and then the internet decided to mess up. Okay, so we did the money management. I think we talked about the money management on that one though. All right, so I guess we're going to start here and then we'll finish off. All right, the inside bar candlestick pattern, okay? The inside bar looks like this. Don't get it confused with an engulfing. An engulfing candle, the bigger candle is normally going to be on the right, okay? On the right. So on the inside bar, you have the bigger candle on the left and then the smaller candle on the right for bullish. And then let's see if it shows us a bearish. Let's go back over here. Okay. Bearish. This is what the bearish one looks like. Okay. Smaller body, bigger body. Bullish, bigger body, smaller body. Okay. So the bigger candle is always going to be on the left for these inside bars. All right. The inside bar candlestick pattern. Ma'am. Kaya. It's okay. The inside bar candlestick pattern is one of the most powerful chart setups that professional traders look at. However, most traders fail to trade it successfully. Lack of skills and knowledge and poor education are the major reasons why most price action traders don't make money trading this Japanese candlestick pattern. What is an inside bar candlestick pattern? An inside bar is two candlesticks. The first one is called the mother candle. It is the big and large. It is big and large. And the second one is smaller and it is located on the inside of the mother bar, okay? So it has to be on the inside, all right? They're showing you an example of the inside bar at the top. You have the mother candle and then the baby candle. So it has to be inside. It cannot run a high or a low. It has to stay on the inside of that candle. It says the illustration above shows the inside bars at the tops and at bottoms. As you can see, the second smaller bar is completely contained by the first one, which is the opposite of the engulfing pattern bar, right? So the opposite, on the engulfing, the second one is engulfing the first one. On the inside bar, the first one is bigger than the second one, okay? The inside bar is seen as a reversal pattern because it indicates that the market trend is likely to change, especially when it's located at tops and bottoms. And I don't want you to think of I don't want you to think of when it's located at top or bottom because anything could happen, price could continue to buy. So think of it as at zones, okay? Because at our zones is where we're looking for entries as far as reversals or continuations, okay? The inside bar is seen as a reversal pattern because it indicates that the market trend is likely to change, especially when it's located at tops or bottoms. It is also considered as a continuation signal in strong trending markets. According to Thomas Bukowski, a successor investor and trader with over 30 years of market experience, a bearish inside bar pattern in a bull market can indicate a bearish reversal in about 65% of the time. This is why you don't want to just take it at a top, okay? In a bull market, and in a bull market, it represents a bullish continuation signal in about 52% of the time. And a bullish abandoned baby, as he call it, is considered a bullish reversal pattern 70% of the time in bull markets and 55% in bear markets. Okay, so we use these candlestick patterns in other with other confluences. Okay, so just don't look at these as, oh, I see it on the chart, price is going to reverse. No, you want to have at least 3 confluences before entering. Okay. So the psychology behind the pattern formation. The inside bar formation indicates a period of consolidation in case of a bullish trend. It reflects that the bulls are not buying any further on the second day. It is represented by a small black candle on the second day after a strong uptrend. And in case of a bearish trend, it means that sellers are not in control of the market anymore. It is reflected by a small white candle after a strong downtrend. Your understanding of the psychology behind this pattern will help you better identify major turning points in the market and time correctly your entry and exit. How to trade the inside bar candlestick patterns. The inside bar can be traded successfully in trending markets, particularly if the market is moving strongly, because the formation of this price pattern provides you with a great opportunity to join the big move. This strategy is very simple. You have to identify a strong trend and wait for the formation of an inside bar pattern in line with the direction of the market. The formation of this pattern indicates that the market pauses before making its next move. This will allow you to enter the market in the right time and make big profits. All right, so they're showing you a downtrend, okay? And then in these red boxes, they have the inside bar pattern because, again, this candle did not run a high or a low, so it's inside of the previous candle. And they're saying to enter at the bottom of the mother candle. The mother candle is the bigger candle, okay? And then place your stop loss at the top of the mother candle or at the last structure, high or low, okay? As it is illustrated above, the market is trending down. The formation of inside bar patterns give us 3 opportunities to join the trend. And they're saying 1, 2, 3, okay? If you are used to our trading approach, you will only look for selling opportunities this way. You're not fighting big institutions and central banks. You are just trading in the direction that is favored by the market. You can place a sell order after the breakout of the pattern as it is mentioned in the chart above, and your stop loss order should be placed above the mother candle. Your profit target is the next support level. Okay? Now they're showing you the inside bar pattern on an uptrend, okay? Entry at the top of the mother candle, stop loss at the bottom of the mother candle. From the above chart, we can see how this price action setup works significantly as a continuation pattern. To be honest, you're not going to take all these signals into consideration. You have to look for significant patterns that form in specific areas at our zones in the market, such as support and resistance, Fibonacci retracement levels, moving averages, or pivot points. Don't worry about that because we will learn about the important trading tools that we will need to use in combination with inside bar setups to make the best trading decisions. All right, so let's come over to the chart and let's find some inside bar candles, okay? Actually, let's find some zones and then let's see if we can find some inside bar candles at zones, okay? So I'm going to go to the 4-hour chart. All right. And right here, I can mark a resistance zone just because we have 1, 2, 3, 4 areas of rejection. And then I can easily see that price broke through. Okay. Came back, retested it again. So I am going to mark this area as a zone. Okay. And let's see, at this area, do we have any inside bar candles? And I already see one. This one is the mother candle, okay? And this one right here is the baby candle. Let me zoom in a little bit more. Make it bigger for y'all so y'all can see. Okay, the one on the outside is the mother candle. The one on the inside is the baby candle. And they're saying that our entry should be at the bottom of the mother candle, which is right here. Okay. So if you wait for your entry, you would have entered right here on this candle. Okay. And then I see a fair value gap right here. So my exits are always a fair value gap or another support and resistance zone. I like to use the 50%, which is my blue line. And I'll take my short candle. Okay, entry right here. So with this one, you would set a stop or a limit. And as we see, TP would have been hit. And this was a 1 to 2 trade. 32 pip stop loss. Let's do this again. 32 pip stop loss for a 96 pip TP. And right here in this green part in the middle, I can't move my cursor, but it says close P&L, quantity, risk to reward ratio. That's how you know what strategy is that. We're not going over strategies, we're going over candlestick patterns. That's how you know the risk to reward ratio. So it says 2.95, so that's a 2 to 1, okay? So just off of this inside bar candlestick pattern, price coming to the zone, okay? And then price coming back to your entry, exit at the fair value gap. All right, that's one entry. Okay, now here we have another inside bar pattern. We have our mother candle and our baby candle. They say enter entry at the bottom of the mother candle. Now, if you're setting a, with this one, it would be a sell limit, right? Price would have activated here, but then you would have came up and gotten stopped out. Let's see what it is. So entry would be here because the sell limit activated. Stop loss at the top of the mother candle, which is right here. And same TP because price came back to this same zone. All right. You would have gotten stopped out for 37 pips. Now, this is why we was talking about risk management the other day, because you gained 96 pips, right? This is why you always want a 2 to 1. You gained 96 pips. Now you're in the same area, same zone. You took the same trade, but then you lost 37 pips. You'd still be up. I don't know, what is that? 96 minus 37. You still be up 59 pips, okay? What's a stop loss? Where price will automatically take you out of your trade in the negative, okay? Wait a minute. Do I have a template for journaling? No. You know what I use for journaling? I have my own separate Discord. Um, just by myself, and I place all of my trades in there. I put whatever I want on my chart before, and then I put a picture after. So taking pictures and then just take notes on your chart, put whatever you're looking for, your entries, your confluences, and then you take a picture of the setup before and after. That's what I do when I journal. All right, so now we are still inside of this zone, right? We're still inside of these two zones. This right here is an engulfing pattern. This is an engulfing pattern. This is an inside bar, okay? The bigger candle's on the left on the inside bar. The engulfing candle, the bigger candle, is on the right, okay? Just stop. Oh my God, mister, have a life, okay? Let's continue. So the trade hit your stop loss. Yep, trade would have hit stop loss, but this is why you want to have a 2-to-1 or higher risk to reward, because if it was just a 1-to-1, you would have gained some money and then you'd have lost some money. With the 2-to-1, we gained some money, we lost some money, but we're still up in the green, right? We're still up 59 pips, okay? So now we also talked about the engulfing pattern, and I see an engulfing pattern here on our zone, okay? Same thing with the engulfing pattern. You can enter on 50% of the engulfing pattern, but a lot of times I see that price doesn't always come back to 50%. 50% would be this blue line, right? So enter at the top of the engulfing pattern, right here. Stop loss at the bottom, TP at the zone. Another 2-to-1, and now we're up 3 trades, okay? We're up 3 trades. All right, so let's see if we can find another inside bar. This is back at current price. I'm going to delete these zones, and let's go back out. Okay. Inside bar right here. Inside bar. I want to see if we have a zone here or what's going on. Is that just the inside bar in the middle? Okay. So I have a fair value gap right here. Wait a minute, bouncing. Did I catch gold dip? We're not talking about charts right now. We're learning. Supply and demand could be when bouncing between 2 fair value gaps. Supply and demand. This is a demand area, okay? This is a supply area. Supply and demand is the same as an order block. It's the opposite candle before an impulsive push, okay? The opposite candle before an impulsive push. Supply and demand is always at the bottom and top. It's like support and resistance, just looking for it with a different way. All right. Let's go back to the inside bar. Here's another inside bar, guys. I think this is the same inside bar from off that zone. Let's continue going. Here. Okay. This is our last inside bar. I'm gonna zoom in so you can see it. The mother candle, the baby candle. Price cannot run the high or the low. It has to stay inside of that last candle. I mark up everything and I trade whatever gives me a setup. All right. So now entry is supposed to be at the bottom of the mother candle. Stop loss at the top of the mother candle. And you can take it back to the last low. This one, you'd have been in for a while. especially since we're on the 4-hour chart. But we're just showing you the trades on the chart, okay? This one is a 5-to-1, but it played out, okay? This is GU. It's a Saturday. We're not trading. We're going over the charts, okay? We're going over candlestick patterns. All right, so again, another example of a bearish inside bar. All right, let's continue to look for more inside bars. This is not an inside bar. I have to keep pointing out the engulfing candles, okay? This is an engulfing candle. Price ran the low and the high of the previous candle, okay? Engulfing candle is on the right, inside bar is on the left, okay? Inside bar on the left. I do top-down analysis. I enter my trades on the hour below. All right, here we go. Here's another inside bar right here. We have our mother candle and we have our baby candle. All right, set a sell stop. Price came through, automatically triggered your trade. Take price to the last low. And TP hit. So me personally, before I started reading the Candlestick Bible, I wasn't looking for these Harami patterns, these Harami candlestick. I love an engulfing and I love a morning star and an evening star. Here's an evening star right here. It's a 3 candlestick pattern. Here's a morning star right here, 3 candlestick pattern, right? I love to see those at a zone, but I'm definitely going to start looking for these inside bar candlestick patterns now. Okay, so let's continue on the book. How to trade the inside bar breakout with support and resistance. A lot of people trade on the 4-hour because there are swing traders. So, I mean, you can't tell somebody else. Some people trade on the daily. If I see a signal on the daily, I'm going to take it. You're afraid to take patterns without a sweep? Do what you do, boo. Do what you do. Technical analysis can be very complicated if you don't focus on the most important basics, such as support and resistance levels. These areas represent a psychological level where the game is played between buyers and sellers. Let me give you an example. If sellers overcome buyers, they will push the price below the support level. Some buyers will feel afraid to lose money because they see that the support level is broken, so they will get out and sell the market again to cover their loss. Other participants will notice that sellers are in control of the market. They will decide to sell the market and help the bears push the price to go down. As a trader, if you have enough knowledge about support and resistance levels, when you open your chart, you will notice that the support level is broken and the bears are in control of the market. This is a good selling opportunity, right? But the question is, what is the right time to enter the market? I think they meant when. When is the right time to enter the market? The inside bar pattern is one of the most reliable price action signals that will give you the right time to enter the market and make big profits. Once you understand how to use it in combination with these levels, you will get clearly what the market is telling you. You will see clearly what the market is telling you. You will make good trading decisions. All right, so here they are showing you support and resistance, okay? So right here, they're showing you a support zone. You see price rejected it once, it rejected it twice, and then price decided to trade through and now become resistance, okay? So they're saying price traded through and then it gave us an inside bar. This is what I like to call a break and retest. You have minor structure break and retest, and then you have major structure break and retest, right? When you see that price trades through and then comes right back on the lower time frame, that was a minor structure break and retest. But it looks like this, like on the hourly. This one is saying H4, so it looks like this on the H4. And then you'll have a major structure breaker retest where price comes all the way away from it and then comes back and touches it, okay? So I like to take advantage of both of them. So this right here is showing you on a higher time frame a minor structure break and retest, okay? So price broke through and then it came back and touched it. It tried to close above, but it couldn't. And then it came back and the bears continued to push price down, okay? And it closed underneath the zone. So now they're saying enter at the low of the mother candle, okay? So price falling, your sell stop activates, your stop loss is up here, and then profit TP at the next zone, okay? The illustration below shows how sellers broke the support level. The formation of the inside bar pattern after the breakout of this level signals indecision in the market. Right now, no one knows if the support level is really broken. If you sell at market immediately after the breakout of this level, you are making an aggressive entry, which is a little tricky and dangerous because the breakout is not confirmed, right? You always want to wait on a retest to confirm if price is going to sell or if the price is going to continue to buy from that zone, okay? But if you are used, but if you are used with trading, what? But if you are used with trading inside bars, if you are used the trading inside bars, if you are using the trading inside bars and you understand the psychology behind the formations, you will know that the safest entry should be after the breakout of this pattern. The breakout of this candlestick pattern is a clear confirmation that the market is not still in an indecision period and sellers are obviously in control of the market. All right, so now they are showing you a resistance level, okay? So support is normally the floor here. Support was the floor. And resistance is normally at the top. So now we have again rejection, 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 and then price finally breaks through and is showing you that inside bar candle. Price closed on top of the zone, and then that second candle came back and retouched it, and then price pushed back up, okay? So a small break and retest. Enter at the top of the mother candle, stop loss at the bottom of the mother candle, and then TP at the next zone, okay? The chart above shows how the market participants interact with these levels and how the resistance level acts as a barrier. The market has had difficulty rising above this horizontal level, prevents buyers twice from rising any further, but in the third attempt, buyers broke through the resistance level. What is interesting is what happened after the breakout. Look at the chart again. You will notice that there is a clear inside bar pattern formed over there. The formation of this price action pattern indicates that the breakout is not yet confirmed. Remember, an inside bar formation means indecision and hesitation. So you have to be careful and bear in mind that a false breakout scenario is possible. What will make a difference between you and other traders is your deep understanding of how this pattern works. In this chart above, you will know that the best time to place a buy order should be after the breakout of the inside bar pattern, not after the breakout of the horizontal level. So they're saying, wait for the pattern, don't just wait for price to break out of the zone. Okay. So we can come back to the chart, right? And find another inside bar pattern again at a zone. I'm looking for another one of those patterns. We may have to go to a different chart. Let's see if we can find one on the 15-minute. What platform takes MT4 for US traders? CoinX. The link is in my bio because I use MT5. But they have MT4 and MT5 on it right now. You're welcome. Yeah, I had to get back on MetaTrader after that whole situation where the Russians kicked us off. Yeah, everybody was coming up with their own platform, and then we was having all that glitching. I was like, no, ma'am. Mm-mm. Okay, y'all. I'm looking for an inside freaking bar pattern. All I'm seeing is engulfing. We're gonna find one. I'm gonna find one. Inside bar. I have to remind myself the inside bar is smaller. The bigger bar is on the left. The smaller bar is on the right. Okay. I think I see one, and I think I see a zone. Okay. So I have a zone right here. I have rejection, 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 rejection. I'm going to mark up this fair value gap right here that gave me my zone. Okay. You'll see all this rejection, rejection, rejection. Price broke through it, right? Came back, retested it, fell, retested it again. Here at the zone, we have an inside bar. Right here. This is our mother candle. This is our baby candle. Okay? Mother candle, baby candle. Let me zoom in a little bit more. I want to make sure y'all can see it. Mother candle, baby candle. Now, did y'all appreciate how fast I just found this zone and this? It took me a minute. Okay, so now, again, with these candlestick patterns, these inside bars, whether it's bearish or bullish, at these zones, we want to set. So if it's bearish, you're going to set a sell stop. That is a pending order. We are not getting in until price trades through and activates us, okay? So our entry is at the bottom of the mother candle. Our stop loss is at the top. And then TP at the next zone. I see a fair value gap right here. So I'll put my TP here. Okay. Take profit smacked on the 15-minute time frame. That shouldn't have took all day. All right. Price came and let us in. Took us out 2 hours and 30 minutes. We've gained 34 pips. Okay. And this is a 3-to-1. You only risked 8 pips. So this is, I'm definitely going to be looking for the inside bar. I'm adding this to my trading. Because like I said, again, I'm always looking for, nope, a limit is when price comes back to your entry. So a limit is this, right? This is a limit right here. Price trades up. You set a limit in this order block for price to come back and grab it and then continue. That's a buy limit. A sell stop is you're waiting for price to trade through. Okay. So a limit is when price comes back to your entry. A stop is when price trades through your entry. Okay. All right. So that was one example of that inside bar. I actually don't use a regulated broker. I use an unregulated broker, which is CoinX. I do use a regulated broker for futures, which is Tradeovate. But for Forex, I don't use a regulated broker. I want my money fast. And CoinX pays me within like an hour. So you don't get that with regulated brokers. Okay, let's find another zone. This will be another zone. This will be a resistance zone, right? We got rejection, rejection, rejection. And I do see an inside bar. I'm going to zoom in. Let's mark this zone. Okay. We actually have one of my favorite patterns right here, this evening star. And then we have an inside bar. And this is an inside bar because this, although it came really close to the top of that wick, it did not run it. So it's still inside this bar, inside the previous one. So both of these are accurate selling candlestick patterns, okay? At a zone. Now, TP inside of this fair value gap here. This would have been a sell stop. Entry at the bottom of the mother candle, okay? TP at 50% of the fair value gap, another 3 to 1. Now, when you have these morning stars and evening stars, I try to see if price is going to come back and fill that gap. And it almost filled it to 50%. I like for it to fill it to 50% because then I'll set a limit, right? Price to come back. But a lot of times price doesn't always come back. So you'll enter at the bottom of that bearish candle or bullish candle if it's a morning star, okay? So an evening star, bullish candle, doji, bearish candle. Enter at the bottom, stop loss at the top. TP at 50% of that same fair value gap because this is looking like consolidation right now. And this is a 2 to 1. Okay? Let's see if we can find another zone. All right, so I see a fair value gap here, and I see a lot of rejection in this area. And I can even extend it to the left, and I see more rejection over here also. Okay, so now I want to see, is there a candlestick pattern that's going to let me get into this trade? Now, here I do see a morning star. Okay, we got our bearish candle, our doji, our bullish candle. This is 3 o'clock in the morning for London session. There's no way that I would be up for this, but this one would have hit stop loss. Okay, so let me put it on. Enter here at the top, stop loss below. And then you can just take TP to the next zone, right? Here. And as you see, price came right back. I'm not marking anything up, guys. Markups is on Sundays and Mondays. As you can see, price came right back to this zone. Okay. And it hit stop loss. Now, you can readjust because this is 10 a.m. This was Friday London session. Now we're Friday New York session. And what did we get here? We got an engulfing candlestick pattern, which is another one of the candlestick patterns that we talk about in this book, right? So price ran the high and the low of the previous candlestick pattern. So now we have an engulfing candlestick pattern. With the engulfings, I really like for price to come back to 50% because I don't like a big stop loss. So if you enter here, stop loss here, this is 19 pips, so that's not bad. So long, stop loss at the bottom. Price did not stop us out. TP at the next zone, which would be here. And although, as you see, price continue even higher. Okay. Now, this was 2 trades. Our first trade was a 1.8. Shouldn't have been taking this trade anyways. So this one didn't even count because it wasn't a 2 to 1. Okay. So actually, this would have only been the better trade. But if you did take it because you wasn't following your rules, all right, there's a 20 pip stop loss, okay, and then you recovered with 45 pip TP. So now you're up 25 pips. All right. You don't use TradingView delays info. Okay. Actually, you have to pay for the data for it not to be delayed. Yeah. But, anyways, the market isn't live. We're studying. Thank you for your input. All right. Let's go to the next page. Tips on trading the inside bar action price setups. Trade the bigger time frames. I'm not against trading lower time frames. You can trade this setup on 5-minute time frames, which I just showed you on the 15-minute. You can trade it on the 5-minute, but if you can't trade the hourly or the 4-hour, you don't know what's going on in the higher time frames, you don't want to be on the lower time frames, okay? You only want to be on the lower time frames for your entries. The I'm not against trading lower time frames. You can trade this setup on 5-minute time frame using other technical indicators to filter your signals and take just high probability setups. But you have to be an experienced trader. If you are a beginner, I recommend you stick with trading this signal in bigger time frames, such as the daily, the 4-hour, and higher, the 4-hour time frame. Trading this setup on lower time frames will increase your chance to overtrade the market and take low probability price action signals, and this is the quickest way to blow your trading account. If you focus just on bigger time frames, this will allow you to set and forget your trade instead of being emotionally controlled by the market. You should start trading inside bars in line with the direction of the market, especially in a strong bullish or bearish trend. But don't try to trade it against the trend if you are a newbie. Yes, so if you're a newbie, as they say, the trend is your friend. Please don't try to take counter trend trades, okay? Because the trend is only going to go in the opposite direction for a pullback for so long, right? And you're going to get better risk rewards, okay? And higher pip counts when you're trading with the trend. When you feel like you've mastered trading this pattern with the trend, you can move to trading range bound markets. And range bound markets is just consolidations where price is just going sideways and it's not breaking a support or a resistance level. Remember that not all inside bars are worth your hard-earned money. There are specific locations where this setup works great, so make sure that your signal is located in a key level in the market. Right, so at the beginning where they were saying to trade it in the middle of a trend, like I said, stick to zones, stick to looking for these patterns at a zone, okay? Find different factors of confluence. Trading with confluence means combining different signals to make the best trading decision. To trade using this concept, you need to look for a point in the market where two or more levels are coming together and wait for an obvious signal to form. This trading method will give you confidence in your trading approach and it will allow you to avoid overtrading. How to trade the false breakout of the inside bar candlestick pattern. Have you ever placed an order with confidence, thinking that the market is going to go up, but price hints your stop loss before it starts turning out to your predicted direction? I have been a victim of stop hunting and I was very disappointed, but that happens several times in the market. Banks and financial institutions know how we trade the market, they know how we think and where we put our stop losses and profit targets. This is the reason why they could easily take money from us. One of the most famous strategies that big players use to take money from novice traders is called stop loss hunting strategy. If you've ever heard anybody say stop loss hunt, 9:30 a.m. New York session, especially on like NAS, US 30 SPX, wait for that big candle to finish. So let me show y'all. That's normally what they call stop loss hunt. So I'm gonna go to the 30-minute. And let's find 9:30. That's 8:30, 9:30. Okay. Let's outline this candle. We'll outline this candle, and then let's go down to the 1 minute. Okay. So this is that 30-minute candle in 1 minute. Let's see, 9:27, 28, 30. Okay, right here. Delete it. 9:30. 9:30 starts here. Let me zoom in a little bit more. Okay. 9:30 starts here. Price pushes up, comes back, closes right here. The next candle pushes up, comes back, closes right here, then pushes up some more. Okay, and then pushes back down, then pushes up some more. On the lower time frame, this is showing us lower highs and lower lows, but on the higher time frame, someone could have gotten in up here and then price pulled back, and they put their stop loss here below this opening of the bullish candle, and then they got stopped out. And then price gave us a beautiful engulfing candle. And this is what I say about that, liking to enter at 50% of the engulfing candle. See, it came back to 50% and then stop loss below, especially on these indices, right? So that you're not getting caught up in a stop hunt. Okay. Secrets to trading. What is all your question marks for? Obviously, you don't want nothing and you know all the secrets. So what you here for? Okay. All right. So that's what stop loss hunting is. Okay. When they come in and they push the price into one direction and then they come back, push it another direction, they stop these traders out and then continue going in the direction that they intended on going into. It's happened to be my first couple of years of trading, and understand it's frustrating, especially when you're in a good position and then you get stopped out and then you watch the market go in the direction that you knew it was going to go in. That's some of the most frustrating stuff ever. So if you're ever trading indices, wait until after 9:30. Okay, wait until after 9:30. Wait till like 5, 10, maybe even 15 minutes. And even does it on news, right? You get those big news candles, even on news. Like, I love to trade news. If you wait and let the market show you where it's gonna go, you can catch that movement. Okay. Have you ever placed an order with confidence, thinking that the market is going to go up, but price hits your stop loss before it starts turning out to your predicted direction? I have been a victim of stop hunting and I was very disappointed, but that happens several times in the market. Banks and financial institutions know how we trade the market. They know how we think and where we put our stop losses and profit targets. This is the reason why they could easily take money from us. One of the most famous strategies that big players use to take money from novice traders is called stop loss hunting strategy. This strategy consists of driving prices to a certain level where there are massive stop loss orders, and the purpose is to create liquidity, because without liquidity, the market will not move. Once stop losses are hunt, the market goes strongly in the predicted direction. The interaction between big participants and novice traders create repetitive patterns in the market. One of the most important candlestick patterns that illustrates how big financial institutions manipulate the market is the inside bar false breakout pattern. Your understanding of this repetitive setup and your ability to detect it on your charts will help you better exploit it to make money instead of being a victim of the market makers and bank manipulators. This price action signal is formed when price breaks out from the inside bar pattern and then quickly reverses to close within the range of the mother bar. Okay. All right. So it's showing you here that this is our inside bar, and then this is a false breakout. This is another reason why we wait on our candlesticks to close. Okay. Especially over on the 1 minute, the 5 minute. On the hourly, you don't really have to wait for the candlestick to close as long as you're looking on the smaller time frames to look for a good entry, because you always want to try to get in on a pullback. Okay. So this right here is a false breakout. Price came all the way up here. The buyers pushed it all the way up here. And then the sellers came in and pushed it back into the range. Okay. And this is a bullish inside bar false breakout. We have our inside bar, and then our next candle, our sellers came in, and then our buyers came and pushed it back into the zone. As you can see, there are two types of this price action pattern: a bullish inside bar false breakout that forms when the market is trending down, and it is also considered as a bullish reversal signal when it is formed near a key support or resistance level. A bearish inside bar false breakout that occurs in a bullish trend, and it is seen as a bearish reversal pattern when it is found near an important level in the market. This setup can be considered as a continuation pattern if it is traded with the trend. Inside bar false breakout trading examples. In my experience, the most important levels that traders should look for to trade this signal are the following: support and resistance levels and supply and demand areas, Fibonacci retracement levels, particularly the 50 and the 61% retracement level, 21 moving averages, and trend lines in trending markets, horizontal levels in range bound markets. All right, so this is our zone. Okay, this is our support level. We got some rejection here. Price came to the area, price traded away, and then price broke the support, came back, retested the zone. Okay, it gave us an inside bar, it gave us a retest, and then price traded below. Okay, now we wouldn't have taken this inside bar anyways, right? Because if price is breaking our support area and retesting it, then we know that we're looking for sales because it's underneath our zone. Okay, this is a bullish inside bar. I know it's bullish because my white candles are the bulls and my black candles are the bears. This is a bullish inside bar at this zone, so that doesn't work. We need a bearish inside bar. Okay, this gave us a nice, I wouldn't really call this a pin bar, but the bulls came in, touched it, and then the bears came in and rejected. Okay, so this is saying this was a false breakout. It says, as you see in the chart above, the market was trending down. That indicates that the sellers are in control of the market. So if you decide to sell the market near the resistance level, all probabilities will be in your favor. But the question is when to enter the market and where to put my stop loss. That's always the question, right? If you enter the market aggressively before the breakout of the mother candle and you put your stop loss above it, the market will take your stop loss and go in the predicted direction. So they're saying if you just saw this inside bar candle and you entered at the bottom and put your stop loss at the top, you would have gotten stopped out. Okay? You always want to wait on a retest. Break and retest all day long. I don't care what strategy you're doing. Break and retest. Okay? As illustrated above, big players hunt novice trader stops before pushing the market to go down. If your stop loss was near the resistance level, you would be out as well. If you don't understand the reason why, it is simply because you are a victim of big players hunting stop strategy. If you are familiar with trading the inside bar false breakout, excuse me, you will understand what happened in the market, and you will simply take advantage of this manipulation instead of being trapped by the market. See the example below. Okay, they're showing the same example. We're getting a break and a retest. On this one, they're saying enter at the bottom of that rejection, okay, and then stop loss at the top of that candle. If you are able to identify this setup and you understand the psychology behind it, there should be no reason not to get into the position. Trading the inside bar false breakouts with Fibonacci retracements. Okay, before we go there, let's see if we can find an inside bar false breakout. Okay, so I'm going to delete these zones and then I'm going to zoom out and I'm going to look for an inside bar false breakout. Hmm. I'm seeing more inside bars, but I don't see any false breakouts yet. No, I can't find it. Let's go to GJ. Let's go to GJ. And then I'm on the 1 minute. Let's get to the 15 minute. Mm, I'm on GJ now. I'm not finding a false breakout. I'm seeing a lot of inside bars that actually work, and I'm starting to love it. Like, here's an inside bar. Here's an inside bar. Price is selling. I don't see any false breakouts, guys. Which just goes to show that the pattern works, right? If I'm not seeing many false breakouts. Here's another inside bar with our evening star. Mm-hmm. Okay, here we go. Found one. Now, I do want to zoom out because I found one, right? But is it as a at a zone, because that's a key important part. Okay. So I have rejection, rejection, rejection. This gives me my um support level. Okay. And then I have a fair value gap here, which is why price rejected from this area. All right. And within this area, I saw an inside bar false signal, which was here. But it's false because it wasn't at a zone, okay? So here's an inside bar, right? And if you didn't know that there was a fair value gap below or a support and resistance zone below, and you would have just entered just off of seeing the pattern, which is what we don't want to do. We want to enter at a zone. Stop loss would have been below the mother candle. And as you see, price came down and hit the zone and then gave us a valid inside bar, which is crazy. I didn't even see that. Gave us a valid inside bar. And then TP up here somewhere. Here's a fair value gap. TP can go in here. Okay. So these candlestick patterns at the zones matter. Okay. This is the difference right here between getting in just because you see the candlestick pattern and getting in because you see that the candlestick pattern happened at a fair value gap, or it happened at a support and resistance zone, or it happened at a supply and demand zone. Okay. So the same pattern, inside bar, the same pattern, right? The left candle is bigger than the right candle. The right candle does not run a high or the low of the previous candle. It's an inside bar. All right. And it works at the zone. This would have been a nice trade on the 15-minute Asia session. Okay. So that's the only thing. I don't see any false ones at the zone. But remember, this one was false at the zone because it wasn't even a bearish inside bar candle. It's a bullish inside bar candle. It has to be a bearish inside bar candle if price is selling, and a bullish inside bar candle if price is buying. And matter of fact, this is a bullish candle, bearish candle. This is a bullish inside bar candle. Okay. Bearish, I'm sorry, this is a bearish inside bar candle. Bearish candle, bullish inside bar candle. So that's another reason this should have told you that, nope, this isn't going to start buying, okay? So again, bearish inside bar candle has a bullish candle, which is the left one. The right candle, the inside candle, is bearish. A bullish inside bar candle, the left one is bearish, the right one is bullish, okay? Because it's letting you know, the second one is letting you know the direction that it's going in, okay? All right. Trading inside bar false breakouts with Fibonacci retracements. I don't really know if you're familiar with this technical trading tool. However, I will try to show you how to use it in a simple and efficient way in combination with the inside bar false breakout. What you have to know is that in uptrend or downtrend, the market creates impulsive moves and pullbacks. The Fibonacci retracement helps us highlight the most important pullback levels in the market. The best Fibonacci retracement levels that I personally use are the 50% and the 61% levels. According to my experience, these levels are the most important areas that experienced traders watch in their charts. Our strategy is simple. We select the technical tool on our chart, and if the market moves strongly, we wait for retracements. If the pullback reaches 50% or 61% levels, we need just a price action signal to confirm our entry. Price action signals is what we're going over, these chart patterns, okay? All right, so it's showing you the inside bar with that false breakout, which is, again, price breaking through and then retesting the Fibonacci zone. And we can pull up Fibonacci. He was saying Fibonacci is impulse. And matter of fact, right here in this area, I can put a Fibonacci on, okay? So in order to use your Fibonacci, you have to have an impulsive move, right? We have an impulsive move right here. This is the correction. This is the continuation, okay? I would take my fib out, and I don't have standard fib levels. I use Jessica Lane fib levels, and I learned the Fibonacci from her. Okay, but you'll put your 100. You'll start at the bottom of the impulsive move. Okay, I'm sorry, your 0, your 100, yeah, and then your 0 goes at the top where price is starting to pull back. Now he's saying that the most identified fib areas is the 61, 8, and the 50. I was taught that price, if you're learning how to trade and you're reading the retracements in the market, price can pull back to any of these levels, right? So if price pulls back to the 23.6, that means that the impulse move isn't finished. If price pulls back to the 382, then your TP is the negative 27. If price pulls back to the 50, your TP is the negative 27. If price pulls back to the 618, the 786, the 88, and the 100, because price can pull all the way back to the 100 and still be in this trend, your TP is the 618. If price breaks the 100, then this uptrend is no longer valid, okay? So in this movement, we got our impulse. Price came back to the 786. And let's see if we got a 618 TP. You would have been holding this one for a while, but 618 did hit TP. Okay. So he's saying we are looking for these price action chart patterns at these zones, okay? And this one pulled back. Let me remark it. Here. Price pulled back to the 786. Oh, and we also had a fair value gap here, which was beautiful. Extra confirmation. What candlestick pattern did we get at this zone? A freaking inside bar. I wasn't even looking for that. That's beautiful. When I tell you I'm adding inside bars to my chart patterns, when I tell y'all I love engulfing candlestick patterns and morning star, evening star. I can see those like the back of my hand, right? But these inside bars, it's going to take me a little minute to identify and get them into my head to continue to look for. But here it is, freaking inside bar. I wasn't even looking for an inside bar. I was just looking for the Fibonacci to show y'all the Fibonacci level, and the inside bar is there. And it traded beautifully. So with this one, entry again at the top of the mother candle, stop loss at the low of the mother candle. It's only 21 pip stop loss. Now, since we are doing a Fibonacci, right, I'm not going to TP at the next zone. My TP is going to be at the 27 or the 618. I like to just take the 27. I don't really like to hold to the 618 because if we come back, if I come over for y'all so y'all can see all of that, the 618 was here. The 618 was here, and price did a significant dip and then hit the 618. When you can just hit TP at the 27 and be out in 15 hours, 246 pips. This is why I like JPY pairs too, because JPY pairs gives up the pips, y'all. They give up the pips. Like, in order to find out like a pip range for the week, you just come to the weekly chart, right? And then just measure a weekly candle. And last week, GJ weekly range was 300 pips. This random week, whatever happened during that week, it was 1,200 pips. JPY candles give up the pips. They're a little bit iffy sometimes, but they give up the pips. But I love GJ. We caught 200 pips last week on GJ buy. It was beautiful. All right, so Let's go back. We did the Fibonacci levels. Okay, by adding this technical trading tool to your strategy, he's talking about the Fibonacci, you'll be able, and let me come over here so y'all can get my Fibonacci levels, because I don't have standard Fibonacci levels. So you'll just put the tool, you'll come over here on your toolbar, 1, 2, 3 down, okay? And then first one, it should say fib retracement. Just put it on your chart, then double click it, then change the levels, okay? And these are my Fibonacci levels. And I just explained, if price comes to the 23.6, that means that price is not done. Price is going to continue in that impulse. Price comes back to the 382, TP's the 27. Price comes back to the 50, TP's the 27. Price comes back to the 618, 786, 886. TP1 is the 27, TP2 is the 618. And I can show y'all over here on GU. The week before last, I was looking for the sell on GU, but price wasn't done in this impulsive move over here. So this was our impulse, right? This was our impulse. Some people would count this as a correction continuation, right? But a correction has to come at least to the 382 or more. Yeah, I trade futures too. And if you put your fib at the low and then the 0 right here, you see price didn't quite touch the 23.6, but it just pulled back within this zone, and then it continued. And then if I come here, same thing, price pulled back to the 23.6. That was letting me know that price is not done buying. It continued to buy a little bit. It ran that last high. So now I pull it over here to this 0. Okay. And then price came back to the 50. I caught this sale. And now I'm in holding for this buy. Because again, I had extra confluences. This was the zone. As you can see, we got rejection, rejection, rejection. Price traded through it. Love that break and retest. Break and retest is everything, y'all. Break and retest combined with these candlestick patterns, or rejections combined with these candlestick patterns. Everything, y'all. Everything. Trading is simpler than what a lot of people want to say. It's like you hear all of this chalk and change of character and all this stuff. Da 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 da. Look at your patterns, look at your zones, and look to see if you got a break of structure. Okay, a break of structure. We can come to the hourly time frame, right? A break of structure, you just look for your last high or your last low. This was my last high, okay? And this was my last structure point that took me to my last high. So this is where my break of structure will be. All right? So we got a break of structure. Price is underneath structure. And it's currently in this fair value gap. I am holding for this buy, but looking at this, I might be getting out. We got this break of structure. Price came, broke it, retest. We're probably finna get a sell. I'll see though. We'll see what happens, because on my higher time frame is telling me different. My higher time frame is telling me different. Same thing here, right? This was my last higher low. This was my last high. My daily break of structure is here, right? So on the daily, I don't have a break of structure. I still have continuation. But on my hourly time frame, I do have a break of structure. All right, guys, we got a few more pages left in this book, and then we will go over all of the candlestick chart patterns, and then we'll be done. Okay, so by adding this technical trading tool to your strategy, again, he's talking about the Fibonacci retracement tool, you will be able to identify potential trade setups in the market. If you analyze the chart above without using it, you wouldn't know the reason why the market dropped after the pullback. Fibonacci tool can be used to trade the pin bar, the inside bar, and the engulfing bar setup, as it was discussed in previous sections. The trade above is very profitable because there are lots of factors of confluence that encourage us to place a sell order. The first reason is the trend. It is obviously down. The second reason is the key Fibonacci ratios that represent a resistance level. And the third one is the inside bar false breakout. So they're talking about this illustration up here. One signal is not quite enough to make a good trading decision. You have to look for multiple triggers that support your analysis. This way, you will put the odds of success in your favor. So he's saying triggers, but you'll hear a lot of people say confluences. Okay, this is the Candlestick Trading Bible. It's been known for centuries. It's been around for forever. This is why I trade Japanese candlesticks, because you can actually read them over all of the other candlestick patterns. Okay, one signal is not quite enough to make a good trading decision. You have to look for multiple triggers that support your analysis. This way, you will put the odds of success in your favor. All right. So this is another illustration with the Fibonacci. You can see he only has 1, 2, 3, 4 levels on his Fibonacci: the 100, the 0, and then the retracement. I have the Fibonacci extensions. Okay. So we got our impulse. Okay. Then we got our correction. Price came back to the 50. Didn't quite touch the 61.8, but price came back to the 50. It gave an inside bar false breakout. One, we know that it is false because we got this third candle right here that came a little further down. Remember, when you have the mother candle, the baby candle, the third candle is supposed to go in the direction of the baby candle. Okay, so this is a bullish inside bar candle pattern, and then the third candle should continue bullish. Okay, so it was a false breakout, but again, your entry isn't supposed to be until the top of the mother candle anyways, so you shouldn't be getting trapped in these false breakouts anyways. As you can see, the price moved higher, pull back to reach our key ratios, and then continue higher. The formation of the inside bar false breakout in this area indicates that the pullback has finished and another strong move will take place. Understanding the market structure is very important to know how to use this strategy in your advantage. If the market is trending, you can trade the inside bar false breakout as we discussed before. But if the market is ranging, you have to change your tactic. If the market is ranging, which is consolidation, just leave it be. Go to a different pair. This is why I mark up everything. I mark up everything because there are phases in the market, right? It's either buying, it's either selling, or it's moving sideways. So if your pair is moving sideways, go to another pair. I promise you, they're not all moving sideways. Okay? This is another illustration of the false breakout. Glad you can make it, Peter. Let you see what I have to show. Well, baby, this ain't no circus. This ain't here for no show. Either you're going to learn or you ain't. In the chart above, the market is trading between horizontal support and resistance levels. As you see, if you entered as soon as the market breaks out from the inside bar and the resistance level, you be caught in a false breakout. Okay. Okay. The false breakout has formed because the amateurs tried to predict the breakout of the inside bar and the horizontal level early to pick the top. But the market faked them out and formed a bull trap. If you find this pattern in your chart and you understand that buyers were trapped by sellers, take this trade without hesitation because it is a very profitable and it has very good risk to reward. And as you can see, we definitely demonstrated that. There was about 6 trades that we saw at zones, and only one of them lost, and they all were 2-to-1 or higher risk to rewards. So that's nice. Peter, I don't know what you're talking about. All right. You place a selling order after the close of the break bar and you set your stop loss above it. Your profit target is the next support level. This strategy this strategy is not complicated at all, and it's not, but it requires time and practice to master it, as all of them. How do you get the document? I have a free Discord in my bio and it's in there. But it requires time and practice to master it. Bear in mind that a false breakout doesn't happen every time, and not all false breakouts are worth trading. Okay. Okay. All right. The benefits of trading the false breakout of the inside bar candlestick pattern. If you master trading this pattern, this will allow to stay away from trap traders and enter the market when novice traders have to get out with a loss. This strategy is not a holy grail, and to be honest, none of them are, right? Nobody has 100% win record, as far as I know. I've never met any trader, even a professional, even ICT, even those day traders that like trade for challenges and they do trophies and championships and all of that stuff. Nobody has 100% win rate. Trading is a probability game, okay? And you are trying to take the trade that has the most confluences to give you the best setup. But even the best setup can hit stop loss, okay? That's why you have to have good risk management and good risk to reward. Okay. You have to be prepared to accept some losing trades, but what is interesting about it is that the risk to reward of this signal has a great potential, because when big participants surprises amateurs and take their money, the market moves strongly. And if you can analyze correctly what happened, you will enter in the right time and make big profits. Imagine risking, say, 50 points for 400 points profit. Using this price action strategy will help you predict proper turning points in the market, in advance, and understand how banks and financial institutions trade the markets. All right, so we got another trading example. In this section, I will show you different trade examples to help you understand how to trade the market using all the strategies discussed in the previous sections. Okay, so now they're going to give us a brief rundown of all the candlestick patterns and the strategies that we have talked about. Okay, so this one is the pin bar. Okay, so they're showing us a support area, and it's a support area because it's at the floor right here. Price rejected and traded up, and now price traded down, came back, retested, and at our zone, okay, it retested at our zone, and it gave us a pin bar. A pin bar is when the traders come in and they trade price. In this case, all the traders traded it up, the buyers traded it up, and then the sellers came in and ended it, closed the candle right there, okay? So it closed underneath the zone. That is our pin bar. And then when we have another zone down here, price traded through, came back, retested, gave us an engulfing. Remember, an engulfing has to trade, it has to run the high and the low of the candle. For the longest, myself, I was looking at an engulfing candle, and I saw one right here. I thought this was an engulfing candle. This one right here, just because it's bigger than that one. This is not an engulfing candle. This is an engulfing candle. It has to run the high and the low of the previous candle, okay? All right. All right, so it's showing another. This one is definitely consolidation because as you see, price is moving sideways, right? And so at the zone, it's showing an inside bar, and then price traded back up to the zone, and then it's showing another pin bar, then price traded back down to the zone. All right, it's showing pin bars. See if there's anything else on here that we need to read. Okay, let's read the money management strategies. We have like 7 pages left, and then we'll take all of these candlestick patterns over to the chart. Okay, money management strategies. Now you have the strategies. You know how to analyze the market. You know when to buy, when to sell, and when to exit. You know also when to stay away from the market. Real quick, when do you stay away from the market? Answer that for me. Or go to a different chart, a different pair. And if you like one pair, that's fine. You just know that that won't be your trading day when this is happening. When do you stay away from the market? Yes, when it is choppy. When price is moving sideways, leave it be. This is important for you as a trader to know, but you are still missing the key to the castle. Ooh, baby, the key to the castle, the money management plan. Because listen, if you are doing a one lot on a trade, even if it's a 2-to-1, right? If it's a 2-to-1, let's say it was a 20 pip stop loss, 40 pip TP. That's a 2-to-1. You did a one lot on that trade. You did a one lot. That means that you lost. A one lot is $10. That means you lost 200 pips. I'm sorry, you lost $200. Now you come back, you do another trade. It's still a 2-to-1. It's a 20 pip stop loss, 40 pip TP. But because you lost that first trade and then you came back and did this second trade and you were skeptical, and instead of doing a one lot, you only did $1, but now you won the trade. Instead of winning $400, you only won $40 because you were skeptical. Money management, guys, risk to reward, risk management is key. Use the same lot size. Use the same lot size, okay? Use the lot size that your account can handle. And I do have a lot size map thing. It's in my free Discord if you guys need help with that. But I say 10 cents per $100. A lot of people say don't risk more than 1%. I'm a risker. I do 5%, 3%, 10%, I'm risky. So I say 10% per $100. Okay. So if you only have $100 in your account, that 0.01 is going to be your best friend. And just take it up 10 cents every time you gain $100. That's going to be the easiest way to compound and grow your account, okay? The most important thing that traders don't talk about is the money management. This is what makes a difference between successful traders and losers. If you trade without a money management plan, you are just wasting your time and money because nothing is going to work for you, even if you have the most powerful trading system in the world. Most traders focus on how to enter the market. They spend months and years looking for the right system. I don't want you to think like them. You should think differently if you want to become a successful trader. Money management position sizing. One of the most important components of money management is position sizing. And they mean position sizing is your lot sizes or your contracts if you're on futures. I don't know what they call it with options. What I mean by position sizing is the number of lots you are risking per trade. All Forex brokers now offer mini lots as the default position size. The smallest value for a mini lot is approximately $1. That's for indices, okay? For some of these brokers, your smallest lot that they're going to enter, it may say a 1, right? But that's $1. That's for indices. So the smallest for currency pairs is 10 cents. And you know what? I've heard some brokers that do pennies. I'm not sure which one, but I've heard some brokers that do pennies. And there are Forex brokers that offer 10 cents for a mini lot, which represents an opportunity for traders who don't have bigger accounts. They can begin with $250 and they still have a chance to grow it. When it comes to position sizing, you should think in terms of dollars instead of pips. Let's say you are trading 3 mini lots of CAD USA. This means you bought or sold $30 worth of US dollars. If the market moves in your favor, you will win an amount of money equal to $3 per pip. If you make 20 pips, I thought that said 30. Okay. If you make 20 pips, you would have profited $60. Let's break it down. One standard lot is worth about $10 per pip, and one mini lot is worth about $1 per pip. And one micro lot is equal to 10 cents. Okay, so in regular Forex terms, a standard lot, which is 1.00 on your broker, that's $10. Okay, a dollar, which is 0.10 on your broker, that's $1. 10 cents, which is 0.01, that's 10 cents on your broker. Okay. Okay, it says let's say you put 50 pip stop loss and 100 pip as a profit target. This means that if the market hits your stop loss, you will lose 50 pips, which is $50. So you'll lose $50 because they're doing $1 per pip. And if the market hit the profit target, then you'll win $100. The size of your position depends on whether you have a standard or a mini account and how many lots you are trading. This information is important to you because this will help you know how much money you risk on each trade. The risk to reward ratio. The risk to reward ratio concept is what will make you a winner in the long run. Before you enter any trade, you have to know how much money you will win if the market goes in your favor and how much money you will lose if the market goes against you. This is one thing that a lot of new traders don't do. They always calculate what they're going to win and they never calculate what they're going to lose. And then when they lose their whole account, they're shocked. Because if you're with these brokers, you can do 500 leverage, and that's basically just leveraging your whole account. You can literally blow your whole account in one trade if you're not calculating your loss. This is why I love MetaTrader 5 and why I'm with CoinX. I like MetaTrader 4, but MetaTrader 5 is better. Because with MetaTrader 5, you can do, I use CoinX, the link is in the bio. With MetaTrader 5, you can do a sell stop or you can just do any type of pending order, right? And then put your stop loss where you're going to put your stop loss at and put your TP where you're going to put your TP at. And it's going to tell you right there on the line what you're risking and what you're going to make. You don't have to calculate it in your head. So that's why I love MetaTrader 5. Now, I believe Sway does this with theirs, and I believe Trade Locker does it also now because they're mimicking MetaTrader 5 plus TradingView. So I believe even with those brokers, when I first started, it was just MetaTrader 4, and you had to use a pip calculator, and then you had to learn all of that stuff, and then you had to take the time out to calculate it so that you can know what you're going to lose, which is a lot of reason why a lot of traders didn't know what they were going to lose, and they ended up blowing accounts. Now they've made it so easy for you. Take advantage of it before you just enter the market, right? Pretend that you're going to do an order before you do a market entry. Look to see what you could possibly lose, okay? Not even what you could possibly win. Look to see what you could possibly lose. Because are you going to crash out if you lose $50 on a $100 account? That's crazy. Oh, yeah, my eye. All right, so the risk to reward ratio concept is what will make you a winner in the long run. Before you enter any trade, you have to know how much money you will win if the market goes in your favor and how much money you will lose if the market goes against you. Don't enter a trade in which the profit is less than the amount of money you risk. Don't enter a trade in which the profit, yes, okay. Don't enter a trade if the profit is less than the amount of money that you risk. So they're saying you're risking $30, but you're only going to make 15. That's not even a 1-to-1, right? A 1-to-1 is if you're risking $30, you're going to make $30. A 2-to-1 is if you're risking $30, you're going to make $60, okay? Don't ever risk a trade to where you're going to make less than what you're risking. It's not worth it. It's not a good trade. Leave it alone. To be honest, I'm not even going to do a 1-to-1, okay? I think I explained it earlier. If you're doing 1-to-1s, right, that's winning $50, losing $50. So you win one trade, or let's say you win 2 trades, right? And then you lose one. So you won 2 trades, you made $50, you're up $100. Then you lost your 3rd trade, you lost $50. Now you only have $50 left, right? You're continuing to exchange the same money with the market versus if you're doing 2-to-1s, right? And you're up 2, You risk $50, but you're winning 100. You're winning 100. You're up 200. Now you lost 50. Now your account's at 150. Okay? Do y'all understand that? Or do I need to do a chart? Some type of chart. And then I think he goes into it right here. If you will risk $100, for example, your profit target should be at least $200. This is a risk to reward ratio of a 1 to 2 or 2 to 1. You'll hear some people say it backwards. Let's suppose that you took 10 trades with 1 to 2 risk to reward ratios. In every trade, you risk $100. You win 5 trades, you lose 5 trades. So you lose $500, but you will win $1,000. So the benefit is $500. So they're saying that you took 10 trades, you risked 100, you risked $100. You should have gained 200 if you're risking 100. Let's do it here. Okay. So you got 10 trades, right? And if there was a 1-to-1 and win 5, lose 5. All right. I'm sick of TikTok. All right, so we got 10 trades. Let's make this a little bigger. And with the 1-to-1, right? So if you're risking $50 and your reward is $50, okay? So we won 5. We won 5 trades, which is $250. And we lost 5 trades, which is $250. Now we're back at break even after those 10 trades. We don't get to keep anything because of a 1-to-1. Now, with a 2-to-1, 2-to-1 or higher, which is why you always want a 2-to-1. We got our 10 trades. We got 2-to-1. We win 5. We lose 5. Okay? Same risk. It's $50. But now our reward is $100. Okay? Because it's a 2-to-1. So we're doubling what we're making. All right? So now on our 5 wins, we made $500. And our 5 losses, we lost $250. Now we're still up $250. Okay? Hopefully that made it clear as to why you need to do 2-to-1 trades or higher, okay? No 1-to-1s. No 1-to-1s. All right, they're saying the importance of a stop loss. Somebody asked earlier, what's a stop loss? A stop loss is when the market will automatically take you out of the trade at, let's say, that negative $50. So you'll automatically lose $50 if the trade does not go in your direction. Take profit is when the market will automatically take you out the trade at your profit area, okay? So you'll automatically win that $100. Okay, so it says all good methodologies use stops. A protective stop loss is in order to exit a long position is a buy, a short position is a sell, okay? A protective stop loss is in order to exit a long or short position when prices move against you to specify price. The stop loss ensures against a usually large loss and has to be used in one way or another. An initial stop loss can be placed with your order on the trading platform. The trade will be closed automatically when the stop loss is hit. This type of stop loss will allow you to execute your trade and go spend time with your family or friends. This will help you to trade out of your emotion because you know how much money you will lose and if the market didn't go in your direction. Lots of traders use mental stop losses, which you will hear people say that when they enter a trade. They don't place a stop loss because they think that the broker will either do a stop loss hunt, which is not true. Which sometimes they do, but sometimes they don't, right? It just depends. You want to wait on that time so that you don't end up with the stop loss, okay? 9:30 a.m., wait that 15 minutes so that way you don't end up in the stop loss hunt. But don't ever set a mental stop loss. I hear a lot of people say they set a mental stop loss, right? And then they're constantly checking their phones. They can't do anything because they're constantly checking their phones to see if their stop loss hit that they didn't place. Right? That's a mental stop loss. They're waiting for the market to come to a certain area. Sometimes they'll set an alert on the chart, and setting an alert on the chart isn't always the best either because price could just be impulsively moving, right? And your alert go off, and then you'll still lose more than what you intended to because price impulsively moved through your mental stop loss area. Like, it's best to set a stop loss on your broker, okay? So that when price hits that area, it automatically takes you out and you don't end up losing more than what you plan on losing, okay? I think that's all we need from that area. Conclusion. Congrats if you have made it to this point. This is a sign that you are hungry enough to succeed in this business. I have provided you with the most powerful price action strategies that you can use for the rest of your life to make money trading in the financial markets. Your success as a trader has nothing to do with your educational background. You can be a doctor, a lawyer, a physician, a scientist, a janitor. They didn't put that. They put all these high price, like they already getting paid good. we everyday people need money. If you don't follow the rules, you will end up blowing up your entire trading account. Yes, we cannot stress it enough. Trading is about discipline and following your rules, okay? Trading is like learning a new skill. You must be ready to put in the time and effort. Let me give you an example. If you wanted to get a degree from university, you have to spend at least 3 years. It's 4, really. You wake up every morning, you study hard, you follow it with your classes, and if you are serious enough and disciplined, you get your degree. The same thing when it comes to trading. If you are disciplined and you put in time and effort to learn, you will acquire a skill to feed yourself and your family for the rest of your life. Yes, you will get your financial freedom and you will never think of a day job. Never. Some traders spend more than 10 years to find a winning trading strategy to become profitable. Others spend 20 years without results. Fortunately, this will not be the case with you because you have the map, you have the strategy. You will not spend years trying different indicators and strategies. You have everything you need here. What you will need is time to master these strategies. So give yourself some time and spend as much as you can to learn because this is the only way to succeed in this business. Over time, you will develop these trading strategies because you will determine what works for you and what doesn't work. Keep practicing and learning from your mistakes. Don't think in terms of making money as fast as possible. Think in terms of becoming an expert of what you do, and the money will follow you wherever you are. Good luck. Guys, this was a good book. If you missed the first ones, um, they are on YouTube. My YouTube link is in my bio. And real quick before we get off of here, let's go ahead and go back over some of these. So we have our bearish engulfing bar. So now we're just going to go to the chart. We're going to try to find some zones, and then we're going to try to find these candlestick patterns at these zones to see how they'll work out, okay? I use CoinX. The link is in the bio. All right, so here, let's look for a bearish engulfing. Okay, so if I'm looking for a bearish engulfing, it's going to be for a sell. And we have a huge bearish engulfing here on our 1 hour. Remember, in order for it to be an engulfing candle, it has to run the high and the low of the previous candle. It did just that. Now, when I see a candle like this, as far as an engulfing, I'm going to measure this. This is a 73 pip candle. Ain't no way in the world you should get in at the bottom of a 73 pip candle. When you have a huge engulfing candle, I'd say 40 pips or more, you want to wait for price to come back to 50%. So I use my rectangle to measure 50% of everything. I use my rectangle bar, my rectangle tool, okay? And I'm going to go from the top of that engulfing candle to the bottom of that engulfing candle. All right. And 50% is right here at my blue line. Now, as you can see, we got a 50% entry over here. You're going to enter at 50%, and your stop loss is going to be at the high of the engulfing candle. This candle is so big that I can use the fib on this one because this is an impulse, this is a retracement, and this is a continuation, okay? So I put my fib at the top, my 0 at the bottom, right here that took us back up, and my TP, because this came all the way back to the 786. TP1 is the 27, TP2 is the 618, okay? We did get a little drawdown. But TP hit with our engulfing candle, okay? So this is how you would use that one. And then also, if you're a little bit advanced, a little bit more advanced, you would know that this is a, don't get me wrong, guys, with supply and demand, I don't know which one is top, which one is bottom, but this is a supply and demand zone, okay? Or an order block. The last up candle before this impulsive down move, and price actually came, you could have got an even better entry, came back to 50% of this zone, okay? And it would have been an even better move, okay? So that's how you would use the bearish engulfing. Our next candle is our bullish engulfing. Same thing, price has to run the high and the low in order for it to be an engulfing candle. This is not an engulfing candle, okay? Let's find a bullish engulfing. This is not an engulfing candle. I used to think these were engulfing candles. It did not run that low. It's just a very bullish candle, okay? It's a beautifully bullish candle because sellers were here and then the bulls came in and it closed up here with little to no wick, okay? But it's not an engulfing candle. Let's find us a bullish engulfing. Okay. Although this isn't really at a zone right here, I have a bullish engulfing, but this was a whole impulsive move, okay? Right here, price ran the low and the high of the previous candle, completely engulfing that, right? Let's see if we got a 50% retracement. I'm going from the high of the engulfing candle to the low of the engulfing candle. And price came, it did not come back to 50%. So this would have been one of the ones. Let's measure the candle though. All right, it's 29 pips. Remember, if it's 40 pips or more, do not enter it because it's going to be a super high stop loss. If it's 40 pips or more, see if price is going to come back into the candle. Now, although price didn't come back exactly to the T of 50%, but you can still see that price came back into the candle. So you don't always have to enter at the high of these candles, right? But that was a 24 pip stop loss. You entered at the close of that, and then TP up here at the next zone. That was a 2-to-1 engulfing candle. All right. Next candlestick pattern. These dojis are not entry candles. Okay. These dojis are just telling you what's going on with price. Okay. So when you see a doji like this, it just means indecision, right? Buyers and sellers were in the market, and then it closed in the middle, and price isn't really sure which direction it wants to go to. But we are not using these as entry candles. Okay. Dragonfly doji. This can be used as an entry candle, okay? Because sellers, now if it's at a zone, remember we're looking for them at zones, okay? This is showing sellers came into the market, pushed price all the way down here, and then buyers came in and pushed price all the way up, okay? That's showing that a lot of buy momentum is in the market. So let's see if we can find what was it? Dragonfly doji. And sometimes a dragonfly doji and a pin bar is about the same thing, but the pin bar has a little bit of a body. The dragonfly doesn't have any body. Pin bar has a body. Okay. So let's see. Like this right here. This is a pin bar. Right here. Sellers came in, right? And then the bears came in, and then the bulls came in. The sellers came in, and then the buyers came in. But where's a doji? Let's see. Okay. So although this one doesn't look exactly like the picture, because the picture is showing a flat top, but this is a dragonfly doji. This is a dragonfly doji, okay? Sellers came in, then the buyers came in, but this isn't at a zone. And as you can see, price came back and continued to sell. You want to wait for these at zones. Zones matter. And by zones, again, fair value gap, support and resistance, supply and demand. All right, and here's an area with all of our dojis, right? Indecision. Price moves sideways for 1, 2, 3, 4 hours, and then it continued in its bullish move. All right, same thing with the gravestone doji. Buyers came in and pushed price all the way up, and then sellers came in and price closed at the bottom of that candlestick. Okay, we have our morning star. This was one of my favorite bullish candlestick patterns. So a morning star consists of a bearish candle, a doji in the middle, and it could be any kind of doji, and then a bullish candle. So let's go back to the chart. And as you can see, I see these all the time. I spot them so easily. Right here, we have a morning star. Bearish candle, doji, bullish candle. Okay. Sometimes price comes back into 50% of this candle. And as you can see, it did on this day. Price came back to 50%. And then sometimes it doesn't. You just have to, what I say with some of these, split your lot size, okay? So if you're only doing 10 cents, just enter at the top, right? But if you're doing 20 cents, do your first trade at 10 cents, enter at the top. If price comes back, fill 50%, then put your second position in and enter at that 50%. Now you have 2 trades running and you're not over leveraging your account, okay? So split your position because all the time you're not always going to get 50%, okay? All right, the evening star is just the opposite of the morning star, and it's the selling. And we are looking for these 3 candles right here. Bullish candle, doji, bearish candle. It could be any kind of doji, guys. Any kind of doji. As long as it's a bullish candle. And as you can see, the bullish candle is a doji too. It just has to be a bullish candle, a doji, and a bearish candle. And in this case, this was the perfect doji because this was the one that we were just talking about right here. The gravestone, very bearish. Okay. Bulls came in, pushed it all the way up here. It couldn't break whatever level is up here. Then price came, those sellers came in, price closed at the bottom, and then it continued to sell. Okay. That's our evening star. And then you see that like that gravestone doji and the shooting star look similar, just have a little body to it, right? But it's the same thing. And then what was that other doji? The dragonfly and our hammer. Same thing. This one just has a little bit of a body. Okay? But it's the same thing. All right, and then we just talked about our inside bars, okay? The left candle is bigger, the right candle is smaller. Wait, where's our other inside bar? Our bearish inside bar, okay? We just talked about those. All right, and then we have our tweezer bottoms. So it says the tweezer, where's my tweezer bottom? Tweezer top. I want to find the definition for my tweezer bottom. Let's go. Did I exit that? I'm going to pull it back up because I don't remember. The tweezer tops and bottoms is another one that I need to learn a little bit more about. So let me find the book again, and then we'll find it on the chart. I know I'm going over it. Oh, it's in this channel. Let's go up. Here it is. Okay. Now, let's figure out what chapter it's in. Tweezer tops and bottoms, 43. Okay. Tweezer tops and bottoms. The tweezer top formation is considered as a bearish reversal pattern seen at the top of an uptrend, and the tweezer bottom formation is interpreted as a bullish reversal pattern seen at the bottom of a downtrend. Remember, it has to be at a zone. Okay. So this is a tweezer bottom. A tweezer bottom is a bearish candle and a bullish candle. It's supposed to be a reversal, and they are supposed to start, right, open and close at the same levels. Okay. So open, okay? So wait a minute. This one opened, price bought, it closed. Then this one opened, price sold, it closed, okay? I'm gonna say that again. Price opened. Okay, this is supposed to be a bearish candle. Let me do it right. This is supposed to be a bearish candle. This is supposed to be a bullish candle. So if it's bearish, price is falling. So that means price opened here, then price sold, price closed. Then the next candle opened, the bulls came in, they pushed price up, price closed, okay? So this is a bearish one. Let's find a bearish tweezer bottom. Let's go to a different chart. Let's look at EJ. Okay, here we go. Here's one, but this isn't bearish. This is bullish. Okay. Bearish, bullish. It's tweezer bottom. Okay, this is the one. Bearish, bullish, tweezer bottom. So is tweezer bottom a buy then? Tweezer. I told y'all the tweezer. Okay, so tweezer bottoms is a buy. Tweezer bottoms is a buy. Okay. So a tweezer bottom is bearish and then bullish. So price is going to follow the direction of the second candle. Okay. And it's actually at the bottom of a zone. So this one did actually work out. It looks like price was consolidating here. Price was consolidating here, really. Here. Okay. Price was consolidating here. See that? It was moving sideways. We didn't really get a new high or a new low. Price came back down to the consolidation zone, which would be support. And then it gave us a tweezer bottom, okay? A bearish candle, a bullish candle, and then price continue higher, okay? And then a tweezer top. Where's the top? Tweezer top is a bullish candle, bearish candle, and then price should sell, okay? So it should follow the direction of the second candle. So let's find a tweezer top. All right, this is not a tweezer top. It's not a tweezer top. Let's keep going. Tweezer top. And I've heard some people call it double body candle. Okay. This is not a tweezer top. I'm going to zoom in just so you can see the difference. What candle is this? This is not a tweezer top, but what candle pattern is this? These two right here. This one, these two right here. You can trade it on anything. It don't have to be a prop firm, but I don't trade prop firms. I have a live account. Inside bar. Yes. Banana cutie. Not a double top, babe. Inside bar. It is a head and shoulders, but we're not talking about head and shoulders. Yep, I see the head and shoulders. This is the head. These are the two shoulders. We'll talk about head and shoulders on Monday. I don't even know if it's going to be on Monday, but we are going to start the candlestick chart pattern book. Okay? And head and shoulders is a chart pattern, not necessarily a candlestick pattern. Okay? Yep. So that's an inside bar. Let's find a, still looking for that double top, tweezer top. Hmm. Looking for the tweezer top, which I don't see. Let's go down to a different time frame. We're identifying the candlestick patterns from the Candlestick Bible. We just finished it. Okay, y'all. This is EJ, but the market's closed. We're just finishing the book. Tell me what candlestick pattern this one is, guys. These two right here. I can't find a tweezer top, but this one and this one. What's this? This one and this one. I'm going to delete this. Yep, engulfing. Is it a bearish or bullish engulfing? My pink candles is my bearish candles, and my black candles are my bullish candles. Bearish, yes. Okay, let's see what else. What candlestick pattern is this? This candle, and this candle. This one, and this one. This candle, this candle, this candle. We only have two candlestick patterns that consist of 3 candles. This one is a morning star. Morning star, evening star has 3 candles. Okay? And it's a morning star. We have our bearish candle, our doji, and our bullish candle. Okay? Bearish candle, doji, bullish candle. Let's see. Let's find another. These 3 right here. What's this? 1, 2, 3. 1, 2, 3. One, 2, 3. Bullish candle, doji, bearish candle. That's an evening star. Okay? Evening star. Yes. What else? What's this one? 1, 2, 3. Remember, we got 2 candles, 2 candlestick patterns that has 3 candles. It's either a morning star or an evening star, okay? And you know it's a morning star because the 3rd candle is bullish, okay? So bearish candle, doji, bullish candle. Evening star. Did I delete it? Let's find another one. Morning stars and evening stars are everywhere, y'all. I swear those and engulfings are the easiest. Okay. Here's another one. It's 1, 2, 3. Okay. Evening star, because the third candle is selling. Is this a continuation entry? So continuations, to know if price is reversing or if price is continuing. So this is a perfect area right here, right? I use fair value gaps, and sometimes I use support resistance. Sometimes I use supply and demand. Just depends on what's going on. Okay. So I mark up my gap. Price comes back to 50%. In order to know if price is continuing, because we got this big bullish impulse and then we got correction, right? And then this is where we would look for continuation of the bullish, right? That's continuation. But if price is going to reverse, right? Remember, we had bullish, we had correction. If price is going to reverse and not continue to buy, then it's going to break this zone and trade through it and then come back and retest it. So you're always still going to look at this zone to let you know if price is going to continue or if price is going to reject and go the other way. Okay? That's the difference between, I forget y'all can't see my whole chart. I'm sorry. Hold on. Let me do that again. Okay? So we got this big bullish impulse right here, right? I have a fair value gap from that bullish impulse. I mark up 50% of my fair value gap. And I want to see when price comes back to 50%, if price is going to reject it and continue this buy, or if price is going to trade through it, come back and retest it, and then reverse into a sell. Okay? So that's how you know the difference between continuation and rejection and reversal. Okay? So we got this big impulse. Price came back to the zone. It gave us a morning star here. And it gave us an engulfing here with that little black one. But you could have got in here. And then price continued. Right? But to know if price is going to reverse, we got this big impulse. Again, we want to watch 50% of our zone. If price trades through it, comes back, retests, rejects, then we looking for sells. Okay? But sometimes price can give us this big bullish, and then it could come trade underneath the 50% and still end up on top. So you always want to wait for price to get to your zone to let you know if it's going to continue or if it's going to reverse. Okay? Does that make sense? Did you understand that? Let's say here, right? This is resistance. I see rejection. I see rejection. I see rejection, right? So now I have a zone here. Okay. Price came to the zone. It gave me an evening star. Price sold off. Price came to the zone again. Price came to the zone again. Didn't necessarily give me any kind of candlestick pattern. It gave me a pin bar, right, that closed on top of that 50%. And then the next candle came and closed underneath. And then price sold off, right? And then we came back to the zone. Price rejected it again. Price did not give me a candlestick pattern here, but since this is on the hourly, I'm pretty sure we could have went down to the 5-minute, 15-minute, and it could have given you some type of candlestick confirmation to let you know that price was going to sell. Okay. And price rejected. Now we got our impulsive move through, and then price came back. We didn't get a full retest of this zone, but price came back and then continued. So you always want to wait at your zone to see what price is going to tell you that it's going to do. Okay. Whether it's going to continue or reverse. You don't always want to assume that, let's say you got a morning star at a zone. You don't always want to assume that price is just going to continue because you saw a morning star. Okay. You want to wait for price to let you know what it's going to do. So I can do this area right here and then come down to the 15-minute. And although I didn't know what was going on the hourly, you see here on the 15-minute, what did we get? An engulfing. So if it's not clear on one time frame what's happening at the zone, go down to your lower time frames. But a lot of times I'm marking my zones up on my higher time frames, and then I'm looking for my patterns and stuff on my 30, my 15, my 5-minute, my 1-minute. Don't do 1 minute if you're not advanced. As low as I would tell you to go is your 5-minute. Okay. But you see right here, we didn't clearly see what was going on in the 1 hour with these candlesticks, but come down here to the 15-minute, clear as day, engulfing pattern. We're going to sell. Okay. Over here, we didn't see what was going on the 1 hour. And yet again, what did we get? This isn't really an engulfing. It's not an inside bar. Okay, here. This would be your price action signal, this candlestick right here. Because none of this wasn't an engulfing. This isn't an inside bar. That's not an inside bar. It's not an evening star. None of that, right? Price came underneath it. It retested it again. You did get an inside bar here, right? So you could have got in at the bottom of the mother. And then you got an engulfing. That was 2 confluences at that zone to let you know that price was going to sell. Okay. But of course, this was the signal that came up first. So you'd have been in a little bit of drawdown. And you could have put your stop loss at the top of the mother like they said. Or you can put your stop loss here at this last high. That's still 18 pips is still good. And then somewhere down here, I'm sure is a zone. Okay. This was our last low right here. That's TP. 5 to 1. All right. So it's important to know these candlestick patterns. As for price action traders, price action traders is people that follow the candlesticks and see what's going on. So on Monday, I'll be back. Not sure what time. Just hit my name and then click the notification bell. And then if you miss a live, I upload these lives to YouTube. My link is in my bio for YouTube. So you can go back and watch all of the ones for the Candlestick Bible. Okay. So on Monday, we'll be starting, what book? It's in my Amazon cart. I don't know what it's called, but it's one of these candlestick pattern books, right? And candlestick patterns, like one of the gentlemen was talking about, the head and shoulders. You have wedge patterns. You have triangle patterns. There's so many freaking candlestick patterns. And we want to tune our eyes to them. Let's see. These aren't really patterns. Okay, these are more so patterns, but y'all can't even see this. I can't bring that over. Why can't I bring this over here? Okay, can y'all see this? It looks too dark though. Trying to show y'all a quick example of the candlestick patterns, but doesn't look like we're gonna get any because everything's pulling up on the right side of my screen and y'all can't see the right side. See if I do this. Just put it on the left. Okay. So you have flags, and then you have ascending triangles, you have descending triangles, you have bearish flags, you have bullish flags, you have wedges, there have head and shoulders, you have inverse head and shoulders. So on Monday, we're going to start that book and go over all of the candlestick patterns to go along with the candlestick patterns and the chart patterns. Okay, I'm losing myself. All right. So let me know if you guys have any more questions before I end this live, okay? Any more questions? Sounds good. I appreciate the participation. Hope you guys learned something today. I do trade live on YouTube, and I also have a signals group. It's free for the first 30 days if you want to come and try it out, earn some money. After the 30 days, it's like $44 a month. Okay. This week we caught 350 pips in the market. So we do make some money up in there. The link is in my bio for that. And then I do have a free Discord also to where I do call out some signals sometimes there. All right. But if that is all and we don't have any more questions, I'm going to go ahead and end the live. And you guys have a great Saturday. Jesus is King. I'm sorry you just joined. You missed the live. Jesus is King. Praise the Lord. All right, guys. I'll see you guys on Monday. Y'all have a good Saturday. TikTok be on some mess with me. It's primary direct. This is a line. Hold on. Let me peel this before I go. All right. Later, guys.